If the Federal Reserve cuts interest rates in September 2024, several potential economic and market impacts could occur. 1. Lower borrowing costs. A rate cut typically lowers the cost of borrowing for individuals and businesses. This can encourage more spending and investment, stimulating economic growth. 2. Increased consumer spending. Lower interest rates can reduce the interest payments on mortgages, loans, and credit cards, leaving consumers with more disposable income to spend on goods and services. 3. Boost to the housing market. Lower rates can make mortgages more affordable, potentially increasing demand for housing and boosting the real estate market. Lower interest rates can be positive for the stock market, as cheaper borrowing costs can lead to higher corporate profits. Investors may also shift money from lower-yielding bonds to stocks, driving up stock prices. Weaker currency. A rate cut can lead to a depreciation of the national currency, as lower interest rates may make investments in that currency less attractive to foreign investors. This can boost exports by making goods and services cheaper abroad. Inflation considerations. If the economy is near full capacity, a rate cut could increase inflationary pressures. The Fed must balance the need for economic stimulation with the risk of higher inflation. Market sentiment. The reaction of the financial markets will depend on the context of the rate cut. If it is seen as a response to economic weakness, it may have a different impact than if it is perceived as a proactive measure to support growth. The specific effects will depend on the state of the economy at the time of the cut, the size of the rate reduction, and the guidance provided by the Fed regarding future monetary policy.